Welcome back to the channel. As always, if you copy trading, you're an absolute moron and you deserve to lose all your money. And with that out of the way, we're going to look today at a short which has been absent from the channel for a while. And the company is BIDU Incorporated, ticker BIDU. And of course, as you can see, the company has been in a downward trend for over a year. We obviously have had a big rally over the last few weeks due to the China stimulus that was announced, and that seems to have now come to an end. So the froth is now out of the Chinese equities, and there has been some sentiment lately that the measures that were introduced, even though were very well received at the beginning, are not going to be enough to contain the gloomy outlook for the Chinese economy. So because of that, we can see that the rally for this stock at least seems to have peaked around the teens, past 100, right? And we're now stagnating just above 100. But I do think that there is further downside for the stock to come back to previous levels and potentially even more down the line. Why is that? Well, if you know this stock, uh, I'll just explain real quick, just give you the description real quick. But in essence, they are the Google of China. Okay, the description seems to be missing here for some reason, but their business model is Google of China. Okay, that's what they do. So if we zoom out a little bit more, you can see that this company obviously did very well during the pandemic. The market went bust, and now they seem to be on a structural decline. If you look at this, you can see that the all-time low was reached in November 2022, and that's not far from the levels that we touched on last month. Okay, so think about it. Just a few weeks ago, we were on multi-year lows for this stock, reached only before in the 2020 lockdown and 2012, when also the market was actually 2013, but the market back then was not doing very well either, right? So you can argue that this company is in structural decline. And why is that? Well, when you look at their business model, their online marketing revenue growth has been stagnating over the last few quarters, and in the last quarter it was actually negative. So they experienced contraction on revenues in their core business model. Now, the company has been allegedly developing LLM earning models and trying to transition from an internet-centric business to an AI-first company. And probably that sounds really good, right? Because as you know, there's a lot of companies doing really well out there. But let's switch this for a second to get a feel for how that compares to the sector. So yes, this is an interactive media and services company, but now that business model is in jeopardy, right? So the narrative they're trying to put now into the market is that they are an AI company. And what AI companies do we have there? We have NVIDIA. Arguably, you could say we have Google as well. They have a similar business model, also entering in the AI. We have Alibaba, right? Salesforce is also putting forward AI, even though it's not exactly the same business model. We got Amazon as well, competing in that sector. And of course, we have all the Chinese counterparts. I think it's called QI or apologies. I think it's IQ. Let's have a look at that. Okay, right. So, of course, we have other AI themed companies like AMD. So this is not a fair comparison, but I'm trying to illustrate how that AI narrative fits into what's happened so far. I don't see this company as an AI company just yet, just because the share of revenues, right, uh, coming from that segment of the company is very small. As a matter of fact, there are a lot of question marks as to when and how they're going to be able to monetize that. And of course, let's not forget, they are not the only player in that. They have a lots of competitors, uh, lots of competitors that are doing better than them and are in a stronger position than them, are in a stronger market than them, and are not subjected to geographical restrictions. So, for example, the adoption of AI from Chinese companies more difficult than US-based companies due to sanctions and so on. But the company keeps saying that they are an AI-based company. Great. Well, they've been doing this since 2023, right? So let's go back a little bit and let's see how that has not really. I'm just going to blur IQ, but you get the point that it's selling at a multiple lower than IQ. So just to make this easier to see, I'm just going to get that out of the way for a second. And you can see that even though they have announced since 2023 their transition, the market has viewed the stock more and more negatively. So it used to be selling at a premium compared to Alibaba, not anymore, right? Is the absolute laggard in the sector. So to me, that signals that the market does not value this stock and does not see this stock recovering anytime soon. We saw how, for example, Salesforce some time ago was struggling quite a while. They've been able to contain that situation. Not the case here, right? So even compared to China peers, this is a laggard. And we have had a recent rally, like I mentioned before, in Chinese equities. That's the reason why we have experienced this. So where does this leave us? Well, I do think that this is a good entry for a short. I'm particularly agnostic as to how this company may do in the medium term. In the short term, I think is a short, right? And because of that, I'm going to take advantage of this opportunity and enter a short position. A risk in this trade, which would be about 3 months, would be further stimulus response from the Chinese government. We could also see in the next earnings, which will be on the 20th of November, the bottoming of some of the legacy business lines. So they have been eroding for quite a while. We could see that trend reversing. We don't know yet. Personally, I don't think we will, because when you look at the KPIs, we can see that their monthly active users have not been getting better. And they do have as well other business lines that are, slowly taking traction. So, for example, driverless car hailing, lots of interesting things. Yes, those things are growing, but they're not becoming anytime soon a significant part of the revenues of the company. They might do someday, but it's not happening just yet. So those are the risks. Onto the structure. So the way I'm going to replay this is with a diagonal spread on puts. We said that the company will be reporting on the 20th. Great. That's not confirmed, by the way. could be a little bit earlier, but assuming that stays the case, we could go along the Januaries. So January's 100 puts at 680 and short the 95s at 242. So that structure, assuming a 95 price target, which is around here, so essentially dropping the 250-day standard moving average down to the 150, that alone would give us 100% return basically within a month, which is it's not bad. We can certainly take that. If that expires worthless, the short leg, we can have that exposure onto earnings 5 days later. But let's say that it has actually moved to 95. Well, we could add another short leg at say 90, get another credit reducing our exposure, and ride that all the way back to 90 for an almost 900% return by the end of December. That's definitely a very, very good play in my mind. So that's the structure. Hope you enjoyed the video. See you soon.